What's up, Internet? Welcome back to the Wallet Monkey channel, where we give you all the credit intel you need to grow your wallet. Today, I want to talk a little bit about personal finance and talk specifically about 2022 and what to really expect from equities markets. Are we really just setting ourselves all up for a giant rug pull? And what's going to happen? So let's look at some data, right? You know, I'm a huge data and analytical junkie, so I hope you'll appreciate what I've put together for you here today. What we're going to talk about is the consolidation of real assets versus financial assets, and just the, progression of how this has gone on through 2021 and now into the first quarter of 2022. Cool? So let's dive right in. Real assets are considered commodities, houses, real estate, property, ships, shipping containers, art, collectibles, commodities, things like that, right? And then financial assets are classified or considered equities, bonds, things like that, right? So speculative things, financial assets, right? Very liquid. Even cash is considered a financial asset. Okay, so what we've seen now collectively is that the amount of real assets has gone down to the lowest level since 1925. That means that financial assets are at the highest level that they've been since 1925. And what's interesting is even in this piece, this data that Bank of America released, this was in March of 2021, they suggested that people start to diversify their portfolio into more real assets. So that was the bank even suggesting people to do that. So let's look at the progression of how this continued on through the year, right? So here we are, this is May of 2021. Stocks now represent 41% of US household financial assets, according to data from JP Morgan and the Federal Reserve. By October, that number really hadn't changed. Here we are, October 1st, and we're talking about 70-year highs still, and it was at 41.5%, again, according to the Fed. So 41.5% of household financial assets were sitting in equities. Mostly, right? And so, okay, well, was it all in equities, bonds? Is it cash? How do we really know? Well, there's a couple things that we can look at here. Biggest one being that the inflow into equities exceeds a combined inflow of the past 19 years. So this is a 12-month rolling average, and we're seeing that it's at an all-time high. So this would tell us that a lot of actual cash and asset is going into the equities, right? Okay, so let's get rid of that for now. And we're going to come back to that. So yeah, what did I want to share here? Okay, so in fact, equity holdings now make up about half of the $109 trillion of financial assets that households owned through the second quarter of 2021. So there's another piece. So we see cash influx going into equities, and then we hear it being confirmed here, according to Bank of America and the data. So here's the the simplest reason why this is probably a bad thing to keep a majority of assets here long term. Overall household net worth jumped to $141.7 trillion in the second quarter as a result of a $3.5 trillion increase in the value of corporate equities as stocks that continued their climb during this period. What happens when they don't continue their climb? What happens if these rate hikes that we're expecting now, and I believe it's expected in March of 2022 this year, so 2 months from now? What happens if we start to see stocks slide? What happens if we get some sort of pullback? Well, all those paper gains that we just got, that added net worth, gone. Extracted right back. So now let's check in with what Charlie Munger thinks about what's going on right now. Here's some of his feedback. He's normally a very reserved, conservative investor. So what he's saying about right now is, because it's two things going on right now. It's equities and it's cryptocurrencies. Now, the reason why people usually feel so good about investing into equities is because it's considered fairly safe. It's not that volatile. We can actually measure the volatility through what's called the VIX, the VIX index. It'll actually measure the volatility for you. So the reason why people like equities is because they're not as volatile as cryptocurrencies. Cryptocurrencies are like the wild, wild west still. So you can have $1,000, $2,000, $5,000 price moves in one day in Bitcoin. Whereas with equities, like a 1% move is huge, right? And we have this belief of this kind of like this normalized rate of return, which averages out to be about 9.5% that we've seen as the average over like the last 3 or 4 decades, something like that. So we've got a fairly safe place that we know that we can bank, 9%, 8 to 9% on average, which isn't bad for the average person. right? But something's changed, and we'll get into more of that in just a minute. But let's continue with Charlie Munger and what he had to say. Cryptocurrencies, he doesn't really like cryptocurrencies. So Charlie Munger says cryptocurrencies should never have been invented, crazier than the dot-com boom. Some of the valuations we saw in the dot-com boom were higher, he said, according to the Australian Business Review, but overall, I consider this as being even crazier than the dot-com boom, which blew up in 2000. Specifically, Munger said that U.S. companies were trading 35 times their earnings, making it tough for average investors to get a foothold with valuations the most extreme he'd ever seen in recent history. This is true. Valuations are very high, so the amount of time it's going to take you as an investor to get into the profit zone is much higher now than it ever was before. Let's talk about that. There's two ways we can measure that. First off, we can look at Shiller PE ratio. So let me pull that up for you. All right, so let's quickly do a definition. What does the Shiller PE ratio tell you? It gives investors a read on whether the stock market, represented by the S&P 500 index, is overvalued or undervalued. The higher the ratio, the more overvalued a market. That means the more expensive a market is. We're seeing valuations at all-time highs. So again, this is a representation from a data standpoint that you're paying a very high multiple right now. And here's where we're at, 39.28. So if we look, that's higher than Black Tuesday and 1929, that's higher than Black Monday, and that's almost as high as the tech boom. So we are literally at like the second all-time high, right? Just below all-time high in terms of a Shiller PE ratio. So that means that we are paying a premium right now for these equities. So why would we do that? So we're seeing a record high amount of money flowing into the markets, but yet we're paying a premium for those. Okay? One other thing I wanted to show you. Okay. I can't remember where I got this data from, but I just got it this last week. And so the number of years it takes to get paid back in equities, priced in. History has shown that when this is high, subsequent real returns are bad. So we've touched now on the 22-year mark. This is the amount of years it takes to get paid back in equities, to actually start to turn a profit. And if we look historically, all the way back to 1900, when we get this high, what happens? What happens? Right? So we've now looked at the fact that there's an overwhelmingly large amount of people's assets parked in financial assets, which are more liquid, yes, but pose the biggest risk to you, and we don't have enough in real assets, while simultaneously the rate of return that we're getting in the stock market is at one of its worst points ever. Make sense? So I think what all of this should really summarize is the need for you to diversify if you're not already, to take a step back and really look at, okay, where are we, allocating our money? Why are we so heavy in equities right now? And how can we start to break out of that and get back into other, let's call them real assets, as defined by, Bank of America and all these other institutions, right? So anyways, I just wanted to share that with you because I think it's huge going into 2022 to make a plan. And if you didn't know this data already, well, then this is going to significantly change, hopefully, how you're looking at this year ahead. Like I said, we've got a rate hike expected for, I think, March. The Fed minute that just came out, which is where Jerome Powell talks about, the Fed and their plan was hawkish, which is considered bearish. And so what's expected now is that there's going to be a rate hike. And after that, the Fed is going to start trimming back and selling off all of the, the equities and bonds and everything else, treasuries that they've been purchasing to help prop up the markets during the last 18 months, right? So we've got all of that going on at the same time, on top of everything else. So anyways, take that as a grain of salt. Comment below with questions or feedback or just something you'd like to comment to help with the algos. Like this video, does the same thing, helps us get in front of more people. Thank you so much for tuning in. Subscribe if you're not already, and hit the bell notification. Be on the lookout, more videos coming soon.